All right. So another thing that comes under the head of the variable consideration is the right to return. Now, you can also say that this is sale on return basis. Sale on return basis. Again, this is very common nowadays. Like, say, for example, there are many competitors in the market and they are going to sell their products to the customers. Sometimes the customers have doubts regarding the quality of the products. So they say to the supplier or to the vendors, okay, we are going to keep your product. If we get a good response, then we can proceed, we can go further on. But if there is no response or a very bad response coming from your product, we'll be returning that to you. Now that is the sale on return basis of the right to return. There can be any reason of that, like there can be the quality reason for that, there can be the price reason for that, there can be the need reason for that. Maybe the customer is getting into the contract and they're saying, okay, we are buying your product but we have a right to return, we can return it. If that is the case, that is going to be treated as a variable consideration because you are not sure whether you will be getting it or not. Note that if the product is sold with the right to return, it is then considered in the variable consideration because again, obviously, you do not have any idea whether you will be getting something out of it or not. So this is variable consideration. A refund liability should be recorded equal to the consideration received that the entity does not expect to be entitled to. Now, obviously, if you have the money, they have paid you the money for the goods, but they say we can return it, then till they make their decision, you cannot record that thing as a revenue because still it is on doubt. So you will be recording that as a liability because they are not sure whether they will be going for it or not. Let's do an example and then you can get the concept. Nadon enters into a 50 contracts with customers. So enters into 50 contracts. Each contract includes the sale of one product for 1,000. The cost of the add-on for each product is $400. Okay, the cost is 400. They are selling it for 1,000, and there are 50 contracts. Cash is received upfront. That means that in advance, and control of the product transfers on the delivery. The customers can return the product within 30 days to receive a full refund. Even you see the ads nowadays. You see, you go on the websites and you're purchasing something, and they say money back guarantee. Money back guarantee. Like if you didn't like the product, you can send it back and we'll be refunding you the full money. Within 30 days, you can send it back. Or sometimes they're giving 7 days, sometimes 10 days. Anyways, they have a different policy for it. Nadon can sell the return product at a profit. And Nadon has significant experience in estimating returns for this product, or they can make the best estimate. They can make the best estimate because of their past experience. It estimates that 48 products will not be returned. That means only 2 products will be returned. The 48 products, the 48 contracts will be accepted, and they estimate only 2 products will be returned. How to account for the above transaction? This is your requirement. Now, as you know, this is the variable consideration because they have a doubt regarding those 2 products. So which method we'll be using? Expected value method. So because we discussed the 2 methods, let's go back and see. First one was the expected value method and the second one was most likely amount. So here the expected value method will be used. So using an expected value method, the estimated variable consideration is 48,000 because 48 products will be accepted. So 48 products will be accepted. So that means they can record the revenue related to the 48,000. The variable consideration should be included within the transaction price because based on the NADO's experience, it is highly probable that the significant reversal is not going to occur. So because it was the criteria of the IFRS 15 that you can record the revenue based on the estimate, but the entity should be sure regarding this thing that the significant reversal is not going to occur. Therefore, the revenue of 48,000 should be recorded and the refund liability of 2,000. Now, what is going to be the double entry? So they are receiving the cash, debit cash, 50,000, credit revenue by 48,000, and credit refund liability by 2,000. So this is going to be the double entry. NADON will de-recognize the inventory transferred to its customers, however, should recognize an asset of 800 as well as a corresponding credit to the cost of sales for the right to recover products from the customers on settling the refund liability. So this is something you should remember because obviously the inventory is recorded at lower of cost or NRV. So if you're thinking the inventory is recorded at 2000, no, this is not going to be the case because the inventory is recorded at lower of cost or NRV. Now you have the financing component. Again, this is something covered under the consideration. The financing component is simply when you are doing the sales, when you are having the sales, but the revenue will be received at some point in future. The amount will be received at some point in future. The amount will be received at some point in future. So that, for example, if I'm doing the sales on 1st January 2020, and I'll be receiving the money on 31st December 2022. That means 20, 21, and 22. 3 years. After 3 years, I'll be receiving the money. Now, there is a concept of the time value of money. There is a concept of the time value of money, and you have studied this thing in your financial management paper, time value of money. Because I'll be receiving the money after 3 years. So now I should record that revenue at the present value. Now I should discount it and it should be recorded at the present value. So in order to calculate the present value, I need to have the interest rate. Sorry, I need to have the cost of capital or I need to have the interest rate. By using the interest rate, I'll be able to calculate the present value. So the simple concept is that you have the present value which you need to calculate, and the formula is future value 1 plus r raised to power minus n. Now r is the rate of interest. Whenever you need to discount it, you need interest rate. N is the number of periods, number of years. All right, so in determining the transaction price, an entity must consider if the timing of the payments provides the customer or entity with the financing benefit. IFRS 15 provides the following indications: the difference between the amount of promised consideration and the cash selling price of the promised goods or service. Now, this is something that, like, when you are usually giving the credit to the customer, uh, this is something quite common in the market, that, for example, if I am selling the mobile phones and the customer is buying those phones on cash, so obviously I'll be giving them a good price. Usually you have studied, the early payment discount, the cash discounts, all those things. So because they are making the payments, I'll be giving them the different price. But if they say, okay, we'll be making the payment after 2 years, then obviously I'll be giving them a different price because I have to make sure, because I am giving my product, I'm investing my product with them for 2 years. They will be paying me after 2 years. Then I'll be giving them a different price. So if this is the case that the cash price is different and you are giving a completely different price when you are giving the credit, this implies that there is a financing component in your transaction. Similarly, the length of time between the transfer of the promised goods and the customer the payment date, like I am transferring the goods on 1st January, they'll be making payment on 31st December. That means there is a financing component. So if there is a financing component, then the consideration receivable, which is the revenue, needs to be discounted. So you have to discount it. All right, we have an example. Root enters into a contract with the customer to sell equipment on 31st December 20x1. Control of the equipment transfers to the customer on that date. The price stated in the contract is 1 million and is due on 31st December 20x3. That means they will be making the payment after 2 years. Sorry. The market rates of the interest available to this particular customer is 10%. This is the rate you will be using to discount it. Required. Explain how this transaction should be accounted for in the financial statements of the root for the year ended 31st December. This is simple. You need to calculate the present value. And I told you present value equals to future value 1 plus r raised to power minus n. So what is the future value? It is going to be 1 million. So let's take in 000. It is going to be 1000. 1 plus r is 0.1 because 10% in decimals, and minus n is minus 2. So it's 1000, and what is this, 0.826, and it is going to be 82,600. Whatever, 82,600 or 82,646, whatever. The receivable is subsequently accounted for in accordance with the IFRS 9 financial instruments. Now, the further treatment will be done according to IFRS 9 because of that unwinding thing you will be looking for. Now you have the non-cash consideration, and I explained you at the start of the lecture that non-cash consideration means that the entity in exchange is not paying the cash. Non-cash consideration can be anything. For example, they are issuing the shares in exchange, or for example, they are again goods in exchange. For example, I am giving you the goods, again in exchange you are giving me the goods. It is possible. It is again common in the market. Like my father has a business. We have the customers who are actually our suppliers as well. We provide them a different product. They provide us a different product. So what we're gonna do when we send them something, they send something as well. So obviously we are dealing with this thing. This is not a barter system we are doing. This is not a barter system. This is not exchange we are doing. This is a non-cash consideration. So in some cases, a customer might pay for goods or services in the form of non-cash asset. For example, a customer might issue the shares to the vendor, which you studied in IFRS 2. You have done that in IFRS 2. So what was the principle in IFRS 2? We will having two types of share-based payment: equity settled share-based payment and the cash settled share-based payment. Now, obviously, you are not paying any cash, so you will be issuing them the shares. Now, what we're gonna do is at first place we will be recording the non-cash consideration at the fair value. If the fair value is not available, then we'll be looking at the standalone selling prices of those goods and services. But first of all, for example, they're issuing the shares. We're going to take the price of the share at first place. If the price of the share is not available, obviously this is not going to be possible because there is a share price. But anyways, if the fair value of the non-cash consideration is not available, then we'll be taking the standalone prices of those goods and services. Let's do an example and then you can get the concept. Dan sells a good to Stan. Control over the good is transferred on 1st January. The consideration received by Dan is 1,000 shares in Stan with the fair value of $4 each. By 31st December, the share in the Stan have the fair value of $5 each. How much revenue should be recognized? So remember this thing that we are entering into transaction on 1st January. So we'll be taking the share price at that date. Once you have recorded the receivable, then the further treatment will be done in the IFRS 9 because this is actually the financial asset. So when you talk about the financial asset, then that will be covered up by the IFRS 9. We are just talking about the revenue recognition, which will be covered in IFRS 15. Now, if the share price is changing further, then you will be dealing with this thing in the IFRS 9. This is the next standard which we are going to do. So make sure that you know this thing that in when we are dealing with the non-cash consideration in IFRS 15, we are just dealing with the revenue thing. Once we get the shares, now this is the financial asset. This is the financial asset for us. And if it changes further, the value of the shares are changing, then we gonna classify it under IFRS 9. So this is what written over here. So revenue should be recognized at 4,000. Now what is going to be the double entry? So first of all, you are receiving the shares. So debit financial asset and credit revenue. So it's 4,000. Now again, a very important thing which you need to discuss in the IFRS 15, which comes under the head of the consideration, uh, determining the transaction price. Remember, we are dealing with determining the transaction price and the fixed consideration, variable consideration, financing component. These all are the components of the transaction price. Consideration payable to a customer. This is very common nowadays. Now let's take multiple examples. First of all, to get the concept that why we will be paying to the customers, why a vendor or a supplier will be paying to the customer. Consideration payable to a customer. Now there are multiple scenarios which can give rise to this thing. The first thing is like you see superstore nowadays, the superstore like Tesco, Super Walmart, these type of superstores, big superstores, the Walmart, things like that. So you go there and you see that when you see the ales, these ales are sometimes designated and only the specific company's products are there. For example, you go in the Tesco and you see that there are only products of, for example, Pepsi's there. So they are the drinks, beverages, they are the Lays, there's the mineral water, and everything is over there. Or for example, you talk about any cosmetic company, you go in the specific aisle, all the cosmetic products are there. Or for example, there's a range of perfumes over there, company's complete perfume range is over there. Or for example, there's a bakery product, a company's complete bakery range is available over there. So nowadays, when you want to sell your product in the superstore and you want to be sold at a specific or designated aisle or designated place, then you have to pay the rent, you have to pay the rental, you have to pay for that aisles to the superstore. Do you know they are doing a very big business? All you need to do just to open up a superstore, and the companies will be approaching themselves and they will be even paying you for selling their products. So that is why you see that these superstores are earning too much, because the companies are, selling them their products, and in order to sell their products they are paying them. Even they're paying them for the advertisements which is within the superstore. They're paying for the ales and all the things. So this is the first case of the consideration payable to a customer. Like, this is first example. If the company is selling to the superstore and they want their products to be sold in a specific ale or a designated place, they will be paying the superstore for that. First example. Another example I gave you was the cashbacks. Nowadays you see it. Like, for example, they say if you buy if you buy our product, we'll be returning you this much amount. Now, first of all, you have to buy their product, you pay them the complete amount, and once you have paid the full amount, they give you the amount. Similarly, you have seen the coupons. Similarly, you have seen the vouchers. Like, for example, you're buying the chips, you're buying the snacks, and then it says like there is a gift under it. For example, you open up the pack, and you see, okay, I have got $1 coupon. Then you give them, and they return you $1. So consideration payable to a customer. It can be anything. It can be, for example, you're paying them for the ales. It can be cashbacks. It can be coupons. It can be vouchers. Now, anyways, it is easier to understand that the entity is paying to their customers. So how this should be recorded? Simply, this is the reduction in the selling price. Simply, this is going to be a reduction in the selling price. This is going to be a deduction in the revenue. Like, for example, if the customer is buying your product for $100 and you say if you buy our product, we'll be returning you $1, that means you should record the revenue at $99. This is simple common sense. So consideration payable to a customer is common nowadays, and consideration payable to a customer includes cash amounts that a vendor pays or expects to pay to a customer. Credits or other items such as coupons, vouchers that can be applied against the amount owed to the vendor. Alternatively, the payment may be part of all amount payable to a customer in return for the supply of goods or services. Many companies are doing this as a promotion. Like in our area, this Pepsi have such policies. I have seen them because I have dealt with them. The Pepsi company, they give the target to their customer. They say, okay, if you're going to sell this much amount of beverages or fizzy drinks in this month, we'll be paying you this amount. So they give the targets to the customers, and once they are meeting those targets, they will pay back them an amount in the form of bonuses. Now, this is ultimately a reduction in the revenue. Consideration payable to a customer is accounted for as a reduction of a transaction price, unless the payment to a customer is in exchange of distinct goods or services that the customer transferred to the vendor. Now we are talking about the same thing. Like, if I'm going to buy a bottle and I get back some amount from that bottle only, that is going to be a reduction. In the case of distinct goods or services, they are going to be treated separate. A vendor might sell goods or services to a customer, at the same time purchases the goods or services from the same customer. If the amount of consideration payable to the customer exceeds the fair value of distinct goods or services the vendor receives in exchange, the difference is accounted for the reduction in the vendor sale transaction price. This is something happening nowadays as well. For I told you in the last slide, my father is doing the business with some customers, and we are buying from those customers as well. So ultimately, we'll be doing the net off thing. Sometimes we will be paying them, sometimes they will be paying us. So that will be a consideration payable to a customer as well. If a vendor cannot reasonably estimate the fair value of the good or service, then the full amount of consideration payable to a customer is deducted from the vendor's own transaction price. If the consideration is paid to a customer in exchange for distinct goods or service, then it should be accounted for as a purchase transaction. Like if you are not talking about the same good, then it is going to be a separate purchase transaction. Let's do an example and then you get it quickly. Example. A vendor manufacturer retail goods enters into a contract to sell goods to a customer, a large supermarket group, for the period of 1 year. The customer is required to purchase at least 20 million of goods during the year. This is the target. The contract requires the customer to make changes to the shelving and display cabinets, aisles, at the stores from which the retail good will be sold. Okay, they have to make the changes at the superstore, like obviously branding the company and then maintaining them in a good way. On the date on which the contract is entered into, the vendor makes a non-refundable payment of $2 million to the customer to compensate for the related costs, because they have to make an arrangement for the display. So the supplier is paying them the $2 million, which is non-refundable, and they will be buying the 20 million goods throughout the year. The payment by the vendor to its customer does not result in obtaining any distinct goods or service, because obviously they are not identifying any. This is because although the shelving and display cabinets will be used by the customer to sell the retail goods, the vendor does not obtain control of any rights to the shelves or displays. Still, that will be the property of the customer, because that is non-refundable and the entity will not be having any control on that. Consequently, the 2 million payment is accounted for as a 10% reduction in the transaction price, because 2 million is the 10% of 20 million. 2 divided by 20 is actually the 10%. To achieve this, the 2 million payment is recorded as an asset and is amortized as related sale of retail goods are recorded. This is very important thing you need to understand, because this question has been tested in the SPR exam and even in the P2 exam. So now every time when they are buying the goods, you're going to decrease your revenue by 10%, because they will be buying the goods of 20 million worth throughout the year. Sometimes they will be buying 2 million, sometimes they will be buying 4 million. So every time you have to deduct 10% from it, and then you will be recording the revenue. This is the first thing you need to understand. Now we have already made them the 2 million amount. We have already made them the 2 million amount. So we cannot record this thing directly as an expense, because ultimately this is going to be a reduction in the selling price. What we're going to do is, with this 2 million, we got a right. We got a right that they will be actually displaying our goods, they will be selling our goods in a particular way. So the treatment is that initially you will record this 2 million as an asset, because you have made the payment in advance, and yet you have to get the benefit of that. And this then will be amortized accordingly. Let's do another example and then you will definitely get the concept. Golden Gate enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million of products over the next 12 months, again 20 million. The terms of the contract require Golden Gate to make a payment of 1 million to compensate the customer for changes that it will need to make in its retail stores. Again, we are making 1 million payment. 1 million, and the total is 20 million. By 31st December 2021, Golden Gate has transferred products with a sales value of 4 million. So yet they have made the sales of 4 million. How the revenue should be recognized? Now, first of all, you need to see that this 1 million is how much percentage of the total sales? It is 5%. Now, every time when we are making the sales, we'll be reducing the revenue by 5%. So how much sales they have made? 4 million. So we'll be recording 3.8 million of the sale. This is something that you need to understand. Now we are moving toward the step 4. The step number one was identifying the contract, which we discussed in detail. The step number two was identifying the different performance obligation, distinct goods and service. We did many examples for it. Then the third step was the transaction price, and we discussed fixed consideration, variable consideration, financing component, non-cash consideration, consideration payable to our customers. And now we are moving toward the step four, which is allocating the transaction price to different performance obligation. Now that means step number two and three will be mixed up when you're talking about the step number four. How? In the step number two, what you did, in the step number two, what you did, you identified different performance obligations, different performance obligations. In the step number three, you determine the transaction price. Now what you're going to do is basically you will be allocating this transaction price to different performance obligation. That means you're actually dealing with the step number two and three in the step number four. So what is the general principle? The general principle is that the transaction price will be allocated to different performance obligation based on the standalone prices, based on the standalone prices. Standalone prices mean, for example, we are buying a car and they will be giving us the services, and then they will be giving us the warranty. Let's take car and services. What if they only sell the car? What is the price of that car? What if they only provide the service to the person who has not bought the car? What is the value of the services? What if what is the price of the car when you buy it in the warranty? What is the price of the car when there is no warranty? So that means you have to look at the transaction price. You have to allocate the transaction price based on the stand-alone prices. The best evidence of standalone price is the observable price. Like you see and go to see your price list. At what amount you are selling just the car, at what amount you are just selling the phones, at what amount you're just selling the internet. Go and see your selling prices, and you'll get to know your standalone prices. If the standalone prices is not directly observable, then it must be estimated. Now, if the standalone prices is not available, then you need to estimate it. Now, again, whenever you're talking about the estimate, this should be the best estimate. Whenever you are talking about the estimate, this should be the best estimate. Now, there are three approaches when you are dealing with the estimates. The first one is the adjusted market assessment. Now, adjusted market assessment means simply at what price. Remember, we are talking about that the observable prices are not available and we are estimating. So the first approach in estimating the standalone price is at what price competitors are selling. If you do not have the standalone selling price, okay, it's fine. We can see at what price the things are available in the market. We'll get to know the standalone price. The second thing is, okay, if there is no observable price, we cannot do it from the market, then the second method will be expected cost plus margin. What is the cost of this product, and normally what margins do you have? That will give you the selling price. If you add the cost plus margin, it gives you the selling price. This is going to be the estimated selling price, standalone selling price. This is the second way. First one was looking at the market, at what price the competitors are selling, at what price customers are buying in the market. The second method is cost plus margins. The third method is the residual. Now, the residual means that you, for example, you have product A, you have product B and C. There is standalone price of A available, there is standalone price of B available, but C is not available. So what you're gonna do, you calculate the A, you calculate the B, and you take C as the remainder. That is the residual. Because you are looking at the three prices, two are available and the third one is not available. So you, what you're gonna do is take the C as a residual, as the remainder. And one of the most important point in the step number 4, other than the standalone price, is that if you are selling in a bundle, if you are selling in a bundle, like when you talk about the bundle, there is product A, product B, service C, whatever. And the standalone prices are different than the bundle price. But usually, when the company is selling in the bundle, they give the discount. If you are giving the discount, that discount will be applied on all the components in the bundle. If you're giving a discount, that discount percentage will be applied to all of the components in the bundle. Now, obviously, we have to do the example, and then we'll be able to grip the concept. A vendor sells three products, A, B, and C, fine, to a customer for $100. This is a bundle price. Each product will be transferred to the customer at a different time. Product A is regularly sold for 50. That means now you see the standalone prices. The standalone price of product A is $50. Okay. Product B and C are not sold separately, and their estimated standalone prices are 25 and 75. Okay, fine. So if they sell B, it's 25. If they sell C, it's 75. Now, what is the total standalone price of these three products? Is 150. It's 150. And they are selling this thing in 100. That means they are giving the discount. They are giving the discount of 50. Now, whenever we are distributing this 100, now we have to distribute this 100 to A, B, and C. So when we are distributing this, we have to make sure that we are actually taking the discount into consideration. So when you're talking about A, 50 is the standalone price, and usually 150 is the standalone price of 3. It gives the discount. When you're talking about the B, 25 is the standalone price, and you divide by 150, which is the total selling price, standalone. 75 divide by 150, and then you multiply it by 100, and then 100, and then 100. So you get the results. So the total is 100. How are we going to split it? A 33, B 17, and C 50. You see, what was the standalone price of A? It was 50. What was the standalone price of B? It was 25. What was the standalone price of C? It was 75. So it makes 150. But obviously you are selling this bundle in 100. So how are you going to split it? You have to split it based on the standalone price, but you have to make sure when you are giving a discount, that discount will be applied to all the components in the bundle. Next example. Shred sells a machine of 1 year's free technical support for 100,000. The sale of the machine and the provision of the technical support have been identified as a separate performance obligation. So Shred is selling a machine and 1 year free technical support for 100,000. So it has two components, machine and installation. So machine and installation. Sorry, it's a technical support. It's a technical support. Machine and the technical support. All right. Machine and the technical support. The sale of the machine and the provision of the technical support have been identified as a separate performance obligation. Shred usually sells the machine for 95,000. All right. So the standalone price is 95,000. All right, it's fine. Uh, okay. But it has not yet started selling the technical support for this machine as a standalone. Other support services offered by the Shred attract a markup of 50%. It is estimated that the technical support will cost Shred of 20,000. Now that means first of all you need to see the total standalone price and then you will be comparing it with 100,000. So the standalone price of the machine is 95,000 as we just discussed, but obviously the standalone price of the technical support is not available. So now we have methods again. We are having the adjusted market assessment, we are having the expected cost plus margin, and we have the residual method. What is the price of these technical support in the market? What is the cost of technical support plus add your margins in it? And then the residual. Now, if you take the residual thing, the total price on which you are selling is 100,000. If you deduct 95,000 of the standalone price, then the remainder is 5,000. So based on the residual, you will be having 5,000, which is the price of the technical support. Now the second method is actually the cost plus margins. Cost plus margins. Now that means 20,000 is the cost plus 50% is the margin, which makes 10,000, 50%. That means 30,000 will be the price of the technical support. So 95,000 is the price of the machine. 30,000 is the price of the technical support. What is the total? The total is 1,25,000. Now the total standalone prices are 1,25,000, but you are giving this thing in 100,000. That means you are giving the discount. Now, how much discount is being given? It is 20%. How you calculated it? 25,000 is the discount amount divided by total 1,25,000. It gives you 20%. So simply what you're going to do, you can make the same calculation which we did last time. What you're going to do is the first way is 95,000 multiplied by 80%, or you just say 95,000 divide by 1,25,000 into what was the price? 100,000. So this is how you're going to calculate it. Similarly, you will be taking 30,000 divide by 1,25,000 multiply by 100,000. So you will record the 76,000 for the machine and 24,000 for the technical support, and the collective amount is 100,000. So this is how you are going to allocate the transaction price to different performance obligation. Now we have the step number 5. The step number 5 is the last step. We are done with identifying the contract. We are done with identifying the different performance obligation. We are done with determining the transaction price. We are done with allocating the transaction price to different performance obligations. And now finally, we will be recording the revenue when the performance obligation is satisfied. Now, recognize the revenue when each performance obligation is satisfied. And when we started the lecture, at that time I told you that the performance obligation will be satisfied either over the time or at point in time. Let's take the example of the car we bought from a car company. They said, okay, we'll be giving you the car plus the 3-year service. 3-year service. One service a year for 3 years. Now, obviously, when we are buying the car, they will be immediately giving us the car. That means the obligation of providing the car will be satisfied at point in time. So they will be able to record the revenue immediately. But the services will be provided over the time, so they cannot record the revenue immediately. Rather than they will be recording the revenue based on the performance obligation is satisfied. So once they are done with the year one, they will be recording the revenue related to year one service. Once they are done with the year two, they will be recording the revenue related to year two service, and then accordingly the third year. When you talk about the performance obligation, this simply means that when you transfer the control to the customer, that the customer takes the control over those goods and services. Now it does not belongs to you. Now they have the control over it. So when you transfer the control to them, that means the performance obligation is satisfied. So control thing is very important. How you determine the control according to IFRS 15. So control in the context of IFRS 15 is simply when the customer obtains the control over that goods and service. And now they have the risk and rewards. Now they can use it. Now they can benefit from it. So what factors will determine the control? Indicators that the control has passed include that the customer, now these are the indicators which indicates that the control has passed to the customer. The present obligation to pay. Now because we have passed them the control, they have obligation to pay us. When we have not provided them the control, they are not obliged to pay us. Physical possession, when we have given them the goods, that means now they have the control. When they have the legal title, that means they got the control. When now they are responsible for those goods and services, they will be getting the reward benefit from it. They will be responsible if something happens to that. Now that means they got the control. Now when they have accepted the asset, okay, now it belongs to us, that means the control has been passed to them. So this is very important thing. So in the exam, in the question, you need to see these indicators. If there are these indicators, that means the control has been passed to the customer. So the benefits of an asset are the potential cash flows that can be obtained directly or indirectly, such as by using the asset to produce the goods and services, using the asset to enhance the value of other assets, using the asset to settle liabilities, selling or exchanging the assets, pledging the asset to secure a debt liability, holding the asset. Now that means if they have the asset, they can use it, they can sell it, they can secure it to take the loans, they can transfer it to someone, etc., etc. This is the control thing that you need to know. All right, moving further. Now we are talking about performing this performance of the obligation over the time. Performance obligation over the time. Now we said that there are two things. Performance obligation will be satisfied at point in time. Sorry, the performance obligation will be satisfied over the time. Over the time means that it will take time to perform your obligation. Like for example, in the contract services, we said it will take 3 years to perform the services. So IFRS 15 states that the entity satisfy the performance obligation over the time if one of the following criteria is met. The first thing, the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. When we are providing the benefit, then they will be able to get the benefit from it. If we are not providing it, they cannot get the benefit at once. Again, see the example of that 3-year service. We cannot provide them the 3-year service at once. They will get the benefit when we perform those services year by year. This is the first point. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced, for example, work in progress. Sometimes we are doing the work in stages, and whenever we are performing that stage, it actually adds something to the asset value. For example, you have to construct a 3-floor building. So once you are done with the ground floor, that means one floor is being added. Then you work on the first floor. That means now it has added something to the building. Now you constructed the second floor. That means you have again something added to the asset of the customer. This is the second point. The first point was the customer simultaneously receives and consumes. Whenever you provide them the service, then they will be able to get the benefit. The second point is when the performance obligation will be satisfied over time is whenever we are doing something, it is creating an asset for the customer. It is adding something. The third point is the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to the payment for performance completed to the date. Whenever we are doing something, even if it is not creating something, even if it is not adding something, but whenever we do something, whenever we perform some action, the customer becomes obliged to pay us. Like for example, we have to make a software for the customer. So in order to make a software, obviously first of all we have to get the license for it. So we got the license. Now we got the license, we paid for it, but it doesn't add something into the software. We have just got the license. Now we have to prepare it. We have to make the software. Still we have not done anything for in the software. We just bought the license. That means that means the entity is now obliged to pay us for the license, although we have not worked yet on the software. So the first point is whenever we are providing them the services, then they will be able to get the benefit. This is the first indicator which shows that the performance obligation will be satisfied over the time. The second factor is whenever we do something, it adds to the value of the asset. The third point is even if it is not adding something to the asset, even if it is not creating something in terms of the asset, but whenever we do something, the customer become obliged to pay us for that step. That means the performance obligation will be satisfied over the time. So if the performance obligation is satisfied over the time, then the revenue is recognized over the time base and progress toward the satisfaction. Now you will be recording the revenue based on the performance obligation. This is a simple example. On 1st January 2001, Avens enter into a contract with the customer to provide monthly payroll services. Now again, apply these three principles. Whenever we are providing them the payroll services, it will not create any asset for them, obviously. So that means this has nothing to do with the asset because these are the services. The first point, can we provide them the payroll services at once? No, because they have to pay their staff monthly. We are providing them the payroll services. We have to provide them the services monthly. So that means when we provide them the services monthly, then they will be able to get the benefit. We cannot do it at once. Can we do it? No, because every time the payroll is going to be different. Sometimes their standard hours will be different. Sometimes their worked hours will be different. Sometimes their pay scale will be different. It is not possible that we can provide the whole year payroll services at once. So that means we are performing the obligation over the time. So what's the year end? 30th June. So by 30th June, we have provided the 6 month services. So we can record only 60,000 as the revenue, not 1,20,000. Example number, whatever, for the example. On 31st March 20x1, Crawford enters into a contract to construct specialized factory for a customer. Okay. So we are constructing now. In the previous example, we were providing the services. The customer paid an upfront deposit, which is only refundable if Crawford fails to complete construction in line with the contract. So that means they are providing us an advance amount, uh, upfront deposit, advance payment, which is only refundable if Crawford fails to complete the construction in line with the contract. If they are not doing the construction according to the contract, then the company needs to refund that upfront payment. Otherwise, it is non-refundable. The remainder of the price is payable when the customer takes possession of the factory. So they will be paying once the factory is completed and they just take the possession of it. They take the control of it. Possession means control over here. If the customer defaults on the contract before completion of the factory, Crawford has the right to retain the deposit. Like if they are not in a position to pay, we will not be refunding them this amount which we have collected from them, the upfront deposit. Should Crawford recognize the revenue from the above transaction over the time or at point in time? Now, what do you think? The revenue should be recorded at over the time or at point in time? This is a very important question over here. They are paying us an advance payment, which is only refundable if we are not complying what we set to do, if we are not doing the things what we set to do. Otherwise, it is non-refundable. The customer will be taking the control at the end when it is completed. The customer will be paying for the factory once they get the control. If they get defaulted, they will not be paying anything to us, and then we will retain their upfront payment. So that means simply that the performance obligation will be satisfied at point in time and not over the time. Because now applying the three criterias which we discussed. The first point, the customer simultaneously receives and consumes the benefit. No, we are building the factory. They will not be getting any benefit of it once they get the possession. So the first point fails. Second point, the entity performs, create, and enhances the asset that the customer controls. No, they'll not. When we are constructing the factory, the customer is having no control of that. And the asset still belongs to us till they get the possession. The third point, the entity performs something that does not create the asset, but whenever we are doing something that creates a liability for the customer, no, because if they defaults, they will not be paying us for the work we have done. They we will only be getting the amount which we got in advance. So that means none of the criteria is being met. So the performance obligation will be satisfied at point in time when we provide them the control and not over the time. This was a very good example. Now, methods of measuring progress, because when we are dealing with over the time, we have to record the revenue accordingly. So there are two methods, output methods and input methods. Now, output methods means now that we will be recording the performance based on the work we have done, work certified method. And input method means that we'll be using the cost. So output method simply means work certified, the amount of work we have done so far divided by total price. This gives you the percentage you have already done. And then you have the input method, which is cost to date divided by total cost. Again, multiply by 100, it gives you the percentage of completion. So this is what we are determining percentage of completion. Example, on 1st January 20X1, Baker enters into a contract with the customer to construct a specialized building for the consideration of 2 million plus a bonus of 0.4 million if the building is completed within the 18 months. So the fixed consideration is 2 million, which they will be getting anyways, plus a bonus of 0.4 million if the building is completed within 18 months. That means this is a variable consideration. They are not sure whether they will be getting it or not. Estimated cost to construct the building are 1.5 million. This is a total cost. If the contract is terminated by the customer, Baker can demand payment for the cost incurred to date plus markup. That means whenever we are doing something that is making an obligation for the customer, because if they leave, they have to pay us for the work we have done. This means this obligation will be satisfied over the time. On 1st January 20X1, as a result of the factors outside of its control, such as the weather and regulatory approval, Baker is not sure whether the bonus will be achieved. So that means just cancel this 0.4 because you are not sure that you will be getting it. At 31st December 20X1, Baker is still unsure whether the bonus target will be met. So ignore this thing because obviously if you're not sure, that means ignore. Baker decides to measure progress of completion based on the cost incurred. The cost incurred to date is 1 million. So what was the formula? Cost to date divided by total cost. So cost to date is 1 and total cost is 1.5. So how much? 75%, if I'm not wrong. 75% of the work is done. All right, so no, it's not 75. It should be 1 divided by 1.5, where 75 means actually 4 portions. These are 3. Let's use the calculator. 1 divided by 1.5. Yeah, it's 66.67%. Anyways, we can use the fraction itself. Uh, Either you can say it 1, you can say 2 by 3, because 2 by third of the work is done. Multiply by 2, 1.3, or you can just multiply it by 66.67%, you will get the same figure. So total revenue was 2 million, but only 66.6% is work is completed, so multiplied by percentage. Similarly, the cost, and similarly, the gross profit. So this way you have to record based on the percentage of completion. Now we have the contract cost. So there are 2 types of the contract cost. The first one is the cost of obtaining the contract. The second one is cost of fulfilling the contract. So these costs should be capitalized. Cost of obtaining a contract, cost of fulfilling a contract, but there are exceptions for it. Let's read. Cost of obtaining the contracts should be capitalized, but this must exclude costs that would have been incurred regardless of whether the contract is obtained or not, such as legal fee, cost of traveling to tender, etc. Now, obviously, whether you get the contract or not, you still have to bear this cost. So this is the sunk cost. This is irrelevant cost. You should not capitalize. This is irrelevant. Similarly, cost of fulfilling the contract should be capitalized, but if they do not fall within the scope of IS2. If you're talking about the inventory, just leave the inventory and rest of the cost should be capitalized. So the cost capitalized will be then amortized in the statement of profit or loss, that whatever you have spent, you will capitalize it. And meanwhile, when you are performing your performance obligation, you will de-recognize your asset, and then obviously you will be recording it in the profit or loss. So how this contract is presented? When entity has recognized revenue before it has received consideration, then it should recognize either a receivable or a contract asset. But that we have actually performed the work, we are entitled to the revenue, we have earned it, but we have not received it. So when we have earned it but we have not received it, then it should be recorded as a receivable or a contract asset. Now there are a few more things which are related to the IFRS 15. One of the case in front of you is actually the warranties, which I gave you the example many times during this standard. Warranty is something like you are giving a confidence to your customer that if the things are not working well, then you can bring it to us and we'll be fixing it for you. Either we'll be repairing it for you or we'll be replacing it for you. So this is known as the warranty, that you are giving the assurance, a confidence to your customers regarding the product service you are offering, that it is going to work the way we are claiming. If it is not working the way we are claiming, then you can bring these products to us and we will be fixing it. Fixing means we either will be repairing it or replacing it for you. So this is known as the warranty, basically assurance to the customers that the product or service will run the same way as we are claiming. If it is not, then bring it to us. Warranties that provide a customer. So there are two types of warranties. The first one is warranty that provide a customer with the assurance that the product will function as intended because it complies with the agreed upon specification. So we are telling them that this is going to work the same way as we are claiming. These are accounted for in accordance with the guidance in IS 37. So if the outflow is probable, you are going to record the provision for it. If the outflow is possible, you will record the contingent liability. So we'll be looking at this thing in IS 37. But if the outflow is probable, then a provision. If the outflow is possible, then contingent liability. The second is the warranty that provides the customer with the service in addition to the assurance that product complies with agreed upon specification. These additional service warranties are accounted for as a separate performance obligation and allocated a portion of the transaction price in accordance with IFRS 15. Like you are telling them, okay, if this is not working this way, we'll be providing you this thing. Not the money you will be giving them. So that means if you are promising any additional action, if you're promising any additional action, that okay, if the things are not working this way, we'll be providing you this thing. If you're working for an additional action, then that means you should record that thing as a separate performance obligation, and the revenue should be allocated to that accordingly as well, again based on the standalone prices. Now the principal versus agent thing is very, very important. The principal versus agent. The principal is the person who is hiring the agent, An agent is the person who will be doing the work on the behalf of the principal. This is the plain definition of the agency theory. The principal appoints an agent works on the behalf of the principal. This is what, by definition, agency theory is. So when a party is involved in providing goods or services to a customer, the vendor is required to determine whether the nature of its promise is a performance obligation, is to provide the specific goods or service itself, that whether we'll be providing those goods and services to the customer ourselves, or we'll be doing that with the help of the third party that is known as the agent. So either we'll be providing them the goods or services ourselves, or we'll be providing the goods or services through an agent or a third party. So there's a difference. When a vendor, in its role as a principal, that means himself, satisfied a performance obligation, it recognizes revenue at the gross amount. Because we are doing the work ourselves, whatever we'll be getting belongs to us. But if we are providing the goods or services to the customer through an agent, then we'll only be recording revenue as a commission. We cannot record the full revenue because that full revenue belongs to that third party who is doing the work on behalf of us, and only we'll be getting the commissions out of it. So then the following points indicate that the vendor qualifies as an agent. Whether you are doing the work yourself or you are doing the work with the help of the third party. So these are the factors which indicate whether the vendor is acting as a principal or an agent. Another third party is responsible for fulfilling the contract. Agent. The vendor does not have inventory risk. Agent. The vendor does not have discretion in establishing prices from the third party. The vendor consideration in the form of the commission. That means he's an agent. The vendor is not exposed to the credit risk. That means the bad debts. That means agent. Non-refundable upfront fee. Non-refundable upfront fee. We discussed in the previous example as well. Advance payment. Advance payment. So a vendor may charge a customer a non-refundable payment, which may be related to an activity that the vendor is required to undertake at contract inception in order to fulfill a contract. Like the basic example you can take is when you go to a gym or fitness club, they say, okay, and then you ask regarding their package. They say, first of all, you have to take an admission. The admission fee is, for example, $1,000. And then you will be paying $100 per month if you want to do the gym. So that means 1,000 is the admission fee that you have to pay anyways, whether you are just going to gym or not. And then if you are going to the gym, going to the fitness club every month, then you have to pay them the monthly fee. So this is the case, the non-refundable upfront fee. For example, joining fee in the health club membership contracts. The vendor is required to determine whether the fee relates to the transfer of promised goods in order to identify the performance obligation within the contract. When a non-refundable fee is not related to performance obligation, like they got the admission, now we do not have any obligation towards that 1,000 because now they have to pay 100 extra in order to do the gym. That 1,000 was only for the admission. When a non-refundable upfront fee is not related to performance obligation but to set up activities, the non-refundable upfront fee is accounted for an advance payment for future goods and services and is therefore only recognized in revenue when the future goods or services are provided. In practice, non-refundable upfront fee typically relate primarily to setup activities and not the performance obligation. Usually we are just getting it in order to get the admission, in order to get into the contract. So that is not related to any performance obligations. Sales-based or usage-based royalties. Sometimes, someone is using my formula, someone is using my design, someone is using my method, All right. And if they are, using my technology, method, formula, name, whatever, and they are using those things and paying to us for that product or design, then that will be recognized as a revenue when we are entitled to that revenue simply. Like, for example, they are using my name, or they're using my stamp, or they're using my design. And my contract is that if you're using my design, you have to pay me royalties per product you sell, or per product that is being sold. So how the revenue will be recognized? The subsequent sale or usage occurs. That means they have used the designs or they have sold the product. The performance obligation, which some or all the sales or usage based royalties have been allocated, has been satisfied. Whether they are getting into production, whether they have made the product, whether they have sold the product, that means they get into that thing. So that means they have to pay us the revenue for the sales based royalties. Now, the repurchase agreement. Do you remember the sale and lease back which we did in IFRS 16? Repurchase agreement. If you are selling a product and you have a right to repurchase it, then in substance, this is a financing arrangement. Because if you are selling a product and you say to your customer, I'll get it back from you after 2 years, that means that customer neither can use it, neither they can sell it, because you will be getting the product back. So that means in substance, you are securing that asset as a collateral and you're getting the loan from them. This is the repurchase agreement. Consignment stock arrangements, common nowadays. Like, for example, the new businesses which they want, who want to sell their product on the stores and outlets, they go to superstores and outlets, and they say, keep our product. If it is being sold, then give us the money by deducting your margins. Otherwise, we'll take our product back. So if that is the case, and even many, like big companies are doing that. Specifically, in Pakistan, the bakery companies, what they have to do, they are keeping their bakery products regularly in the stores, because they are subject to the quick expiry. So what they do, they have to collect it back. So if those products are sold, then they will get the revenue from the customers. If the products are not sold, then they will pick it back. That means they cannot de-recognize the inventory till that is being sold, because that inventory belongs to them. They're just keeping in the stores. If the product is sold, they'll get the money. If the product is still there, they'll get the product back. So that means they should record the revenue and should record the inventory when the product is being sold actually, and that they get entitled to the revenue. Bill and hold arrangements. Bill and hold arrangements means sometimes, like, I am making a product for my customer and I've already made it, and I call them, okay, your product is ready. They say, uh-huh, okay, my product is ready, but currently I'm not able to receive it for any reason. For example, I already have stock in my warehouse, there is no space to keep it, or I'm out of station, whatever. Can you keep it for me for a few days? I'll be paying you an extra money for that. So if we have made a product for the customer and they are not getting it, they have billed for it, but we are holding it for them, and we are actually charging them to keep it for some days, then that means this is an extra performance obligation and we'll be actually getting the revenue for that. But the common sense over here is, when we are billing them and holding their product, it should be completed. It should not we should not get any benefit from that product. That product belongs to customer, and the risk and reward is theirs. Everything is theirs. That is known as bill and hold arrangements. And then the last slide is the disclosures, just as we do by the end of every standard. So again, IFRS 15 requires certain disclosures which you have to make in the notes to the financial statements. So this was a very, very important standard, and hopefully you have understood each and everything. And make sure you are doing the examples, make sure you are just You just know each and every component within those 5 steps, so that if in the exam you have a question, you are able to do it.